You have 3 days left to use up to $135,000 of unused super contribution space. After the 30th of June, part of that window closes forever. Most people in their late 50s and early 60s have heard of the carry-forward rule. The idea is straightforward. If you did not use your full concessional cap in a previous year, you can carry that unused amount forward and contribute it now. For someone with a total super balance under $500,000 that could add up to $135,000 in extra before tax contributions this financial year alone. But here is where almost every guide gets it wrong. They tell you user amounts from the last 5 years. What they do not tell you is which 5 years count. The carry-forward rule only applies to unused amounts from the 1st of July 2018 onwards. And the 2020-21 financial year, the very first year of the scheme, expires on the 30th of June 2026. That is 3 days from now. If you have unused cap space from 2020-21 and you do not act before June 30, that amount is gone. You cannot claim it in July. You cannot roll it into next year. It simply disappears. For some people, that is $25,000 in tax-effective contribution space, vanishing in 72 hours. I am going to show you exactly how the 5-year window works, what numbers to check in your ATO online account, and how to decide whether to act now or wait for the higher cap starting in July. If you are between 55 and 65 and trying to get every possible dollar working for you before retirement, hit subscribe, because this is the kind of detail most super guides never explain, and missing it could cost you thousands. The concessional cap for this financial year is $30,000. If you earn around $120,000 and salary sacrifice $30,000 into super, you pay 15% contributions tax on that amount, $4,500. If that $30,000 had stayed as income, you would have paid tax at your marginal rate of 37%, which works out to about $11,100. That is a saving of roughly $6,600 on that one contribution alone. That is the headline. But the carry-forward rule is where the real opportunity is. The 5-year carry rule allows you to contribute more than the $30,000 annual cap in any given year by adding unused cap amounts from the previous 5 years. If your total super balance was below $500,000 at the 30th of June of last year, you are eligible. And if you have used very little of your cap over the past 5 years, the maximum you could carry forward right now is $135,000. On top of this year's $30,000 cap, that is a potential $165,000 in before tax contributions in a single year. But the 5 years do not go back as far as most people think. The carry-forward rule started on the fund July 2018. Unused cap amounts from before that date do not count. And the earliest year that is still available right now is 2020-21. That year had a cap of $25,000. Any unused amount from 2020-21 expires on the 30th of June 2026. That is 3 days from today. I used to think the carry-forward simply meant any unused cap from any recent year. I almost made a calculation using the wrong starting year, treating amounts from 2018-19 as if they were still available when they had already expired the year before. The ATO's own language is use amounts from the previous 5 financial years, which sounds clear enough. But the 5-year window is anchored to a fixed start date of the once July 2018, not to the current date minus 5 years. That distinction is what trips people up. Let me give you a concrete case. John is 61, works as a mechanic in Wollongong, and has a total super balance of around $380,000. He has never salary sacrificed. He checked his ATO account and found he has unused cap amounts across several years. $20,000 from 2020-21, $12,000 from 2021-22, $8,000 from 2022-23, $5,000 from 2023-24, and $8,000 from 2024-25. That is $53,000 in total carry forward space, on top of this year's $30,000 cap. If John contributes $20,000 before the 30th of June, he uses his 2020-21 carry forward. That reduces his taxable income by $20,000. At his 32.5% marginal rate, the direct tax saving on that contribution is roughly $3,500, the difference between what he would pay in income tax versus what he pays as contributions tax in super. If he waits until 1 July, that $20,000 of 2020-21 space simply disappears. He cannot carry it forward. He loses the tax saving permanently. That is what the expiry means in dollar terms. It is not a technicality. It is real money that is gone. The trap is not that the rules are complicated. The trap is that most guides describe the rule as use your last 5 years of unused cap and stop there. They skip the 1st of July 2018 anchor date. They skip the expiry. And they skip the fact that the 2020-21 year, the first year of the scheme, is the one disappearing right now. So why would John even consider waiting until July? Because the caps are going up. That changes the arithmetic for some people, but not in the way you might expect. Think of your carry forward space as a bucket with 5 compartments. Each compartment holds one financial year of unused cap. The labels right now read 2020-21, 2021-22, 2022-23, 2023-24, and 2024-25. On the 30th of June 2026, the 2020-21 compartment empties, not because you spent it, because time ran out. From 1st July 2026, the bucket relabels itself. The 2020-21 compartment disappears entirely. The oldest year still available becomes 2021-22, which had a $27,500 cap. The carry-forward window now covers 2021-22 through 2025-26, and the new annual cap from the 1st of July 2026 is $32,500. So the overall window becomes slightly more generous, except you have permanently lost whatever was sitting in the 2020-21 compartment. Here is where most guides go wrong. They say you can access unused concessional contributions from the past 5 financial years. That is technically accurate, but it leaves out the critical detail that the past 5 years has a hard floor of the 1 July 2018. You cannot go back to 2017-18. You cannot access anything before the scheme began. The practical consequence. If you thought you had unused space from 6 or 7 years ago, those amounts are already gone. And if you have unused space from 2020-21 specifically, those amounts leave the bucket on Thursday. For John, this framework makes the decision fairly clear. His 2020-21 compartment holds $20,000 of unused cap. If he contributes $20,000 as a personal deductible contribution before 30th June and lodges a notice of intent to deduct with his super fund, he captures that space and claims the tax deduction in his return. Now, what about John's wife, Sue? Her total super balance is $620,000. That means she is ineligible for carry forward altogether. Her balance exceeds the $500,000 threshold, but she is not out of options. Her strategy shifts to non-concessional contributions and the bring forward rule, which I will cover in the steps section. Look, I do not know the specifics of your super history. I do not know whether you have been salary sacrificing, whether you have multiple funds, or where you sit relative to the $500,000 threshold. What I can show you is the framework, so that when you look at those numbers in your ATO account, you know exactly what they mean and what to do next. The 2020-21 amount is the one to check first. If it is non-zero, you have a decision to make before Thursday. So where do the new July caps fit into all of this? The concessional cap was not always $30,000. In the years from 2014 to 2017, the cap was $30,000 for people under 50 and $35,000 for those 50 and over. Then in 2017-18, it dropped to $25,000 across the board, and that cut stayed through 2018-19, 2019-20, and 2020-21. From 2021-22, it rose to $27,500. Then from 2024-25, it moved to $30,000. Those shifts directly affect how much unused space is sitting in each compartment of your carry-forward bucket. The 2020-21 compartment holds a maximum of $25,000, not $30,000, because the cap was lower that year. That is why the maximum carry forward for 2025-26 adds to $135,000 per person, not $150,000. I remember when the cap dropped to $25,000 in 2020. I thought at the time, well, that is less room to grow. I did not realize that 5 years later, I would be facing a deadline to use space from that very year before it expired. That is the nature of a rolling window. The lower caps from earlier years mean less carry-forward potential, but they are also the years that expire first. From 1 July 2026, the cap rises to $32,500. The increase is tied to movements in average weekly ordinary time earnings, the government's benchmark for measuring wages growth. When wages cross a threshold, the cap steps up. The $32,500 figure was confirmed earlier this year. What does that mean in practice? Every year you contribute at the full $32,500 cap. Rather than $30,000, you are putting an extra $2,500 of before-tax money into a tax-advantaged environment. Over 30 years, with an average fund return of 7%, that additional $2,500 per year compounds to roughly $235,000 in extra retirement savings. That is the long-run value of a seemingly small cap increase. So the question is not really carry forward or wait for July. For most people in John's situation, it is, can I do both? The carry forward decision needs to happen before June 30. The July cap increase is automatic. You do not need to do anything to access it. They are separate decisions. But even when the logic is clear, something else tends to get in the way. Here is what actually stops most people from acting. Not the caps, not the maths. It is the sense that I do not fully understand how to do this, so I had better not try. That feeling is completely rational. You do not want to trigger an excess contributions tax bill. You do not want to blow past a cap through a misunderstanding. Staying put feels safer than getting it wrong. So people wait for a better moment, for a clearer explanation, for someone to tell them it is fine to proceed. But staying put right now has a direct cost. If you have unused 2020-21 carry forward space and you do not act before 30 June, that amount is gone. Not deferred, not rescheduled, gone. That is not a hypothetical risk. That is a 3-day deadline. I have watched this kind of paralysis play out more than once. Not because people are careless, but because the system throws ambiguous steps at you. Make a personal contribution. Lodge a notice. Report it in your tax return. Each step sounds like it might require a professional, a phone call, a form you have never seen. So people freeze. One thing can break that freeze. Log into MyGov. Navigate to ATO online services, then go to Super, then look for your unused concessional cap amounts by year. You will see the exact dollar figure sitting in each year's bucket. No forms yet, no commitments, just numbers on a screen. Once those numbers are concrete, once you are looking at $20,000 from 2020-21, rather than some unused space from a few years ago, the decision becomes much simpler. I also want to address something that comes up regularly in the comments. Some people are deeply skeptical of putting more money into super at all. They do not trust the idea of the government controlling access to their retirement savings. That feeling is understandable. But using the carry forward rule is not about trusting the system. It is about using the system's own structure to pay less tax and keep more money working for you inside a vehicle you already have. You still choose how it is invested. You still control when you access it. Within the preservation age rules, the tax saving is immediate. The fund is yours to direct. Understanding the rules is not the same as agreeing with the politics. It is just not leaving money on the table. The rules are clear enough to act on. Here are the 4 steps. Step 1 is to check your total super balance. Log into MyGov, navigate to ATO online services, then go to Super. Your total super balance tells you whether you are eligible for carry forward at all. It needs to have been below $500,000 at the 30th of June last year. That is the 30th of June 2025, for you to access carry forward contributions this financial year. From the 1st of July 2026, your balance also determines your non-concessional bring forward eligibility. If your total super balance is below $1,840,000, you can access the full 3-year bring forward of $390,000 from July. Step 2 is to identify your expiring amounts. In the same MyGov section, look for unused concessional cap amounts listed by financial year. The oldest year currently available is 2020-21. If that figure is non-zero, you have a decision to make before 30th June. The amounts from 2021-22 through 2024-25 will still be available after the 1st of July. Those do not expire for another 1 to 4 years. Step 3 is to decide whether to act now or wait. Here is a practical rule of thumb. If you have unused 2020-21 carry forward space and your marginal tax rate is 30% or higher, contribute that amount before 30th June. The tax saving is immediate, and the space does not roll over if you miss the deadline. For John, with a $20,000 unused 2021 amount and a 32.5% marginal rate, the net tax saving is roughly $3,500 after contributions tax. That is money he keeps by acting now. If you are planning a large non-concessional contribution, say $200,000 or more, there is a case for waiting until July. The non-concessional bring forward limit rises from $360,000 to $390,000 from the WASN July 2026. The total super balance thresholds for eligibility also shift upward. If your balance is between $1,840,000 and $2,100,000, waiting a few days may open up access to partial bring forward contributions you do not currently have. Here is something most guides will not tell you. John and his wife Sue can each run a different strategy in the same year. John contributes $20,000 before the 30th of June using his carry forward. Sue, with a total super balance of $620,000, is ineligible for carry forward. But from the 1st of July, if her balance is below $2,100,000, she can potentially access bring forward contributions. These 2 strategies are independent. They can be used across a couple in the same year. Step 4 is to execute. For concessional contributions, you make a personal contribution directly to your super fund. The contribution must be received by the fund by the 30th of June. Allow at least 5 to 7 business days for the transfer to be processed. Once the fund receives it, you lodge a notice of intent to deduct with them. This tells the fund you are claiming the contribution as a personal tax deduction rather than a non-concessional contribution. You then claim the deduction in your tax return. The notice must be lodged before you lodge your tax return, or by the 30th of June of the following financial year, whichever comes first. If you are still unsure which path fits your numbers, hit subscribe. I post a practical super strategy every Saturday. Next week, I am going deep into the $390,000 bring forward and exactly who should use it before or after July. So here is where you stand. You have 3 days to check one number, your unused 2020-21 carry forward amount in your ATO account. If it is non-zero and your total super balance is under $500,000, you have a real decision to make before 30th June. If your marginal rate is 30% or above, contributing that amount now is almost certainly the right call. The tax saving is concrete. The expiry is real. I went through this decision myself last week. I contributed $15,000 using my 2020-21 carry forward space. It took one bank transfer and a notice of intent form to the fund. No professional needed for that specific step. Once you have seen your numbers on screen and know what you are working with, the action is fairly straightforward. The caps are rising in July. New strategies open from there. But first, check the bucket. Use what is expiring. If you found this useful, hit subscribe so you do not miss next week's deep dive on the $390,000 bring forward. And leave a comment. What is the one super question you have never quite found a clear answer to? I read every comment. Thanks for watching. See you next time.